There's a number that updates every day inside a vault in New York, and almost nobody watching silver spot price on their phone ever checks it. How much physical silver sitting in COMEX warehouses is actually available for delivery, as opposed to metal that's simply being counted and tracked with no intention of ever leaving the building? Most people assume the price on their screen reflects a straightforward supply and demand relationship. It doesn't, not really. Silver's price is set almost entirely in a paper market that is many times larger than the physical metal it claims to represent, and every so often that gap gets tested. This is one of those moments. COMEX, short for the Commodity Exchange, is part of the CME Group and is the main U.S. futures exchange for gold, silver, and other metals. A futures contract is a legal agreement. One side promises to deliver a set amount of a commodity at a set price on a set date. The other agrees to accept it. In theory, these exist so miners, refiners, jewelers, and industrial users can lock in prices ahead of time. In practice, most contracts traded on COMEX are never meant to result in anyone receiving physical metal. Traders are betting on price direction, not planning to drive home with a truck of silver bars. The paper market dwarfs the physical one. On any given day, the ounces of silver represented by open COMEX contracts can be many times larger than the actual deliverable silver sitting in approved warehouses. Analysts disagree on the exact ratio, but even conservative estimates have put it well above 100 to 1 during some periods, meaning for every 100 paper ounces traded, maybe 1 ounce sits in a vault ready to change hands. This isn't a conspiracy theory. It's how commodity futures markets are built, and the exchange discloses it in its own reporting. The interesting question isn't whether the system is secretly rigged. It's what happens to price discovery when a market this leveraged runs into a moment of real physical stress. That's why people watch two categories of COMEX inventory: eligible and registered. Eligible silver sits in an approved warehouse and meets the exchange's requirements, but hasn't been committed to a contract. Registered silver has taken that extra step and can satisfy a delivery request today. When registered stocks drop sharply during a high delivery month, it means the pool of silver available right now is shrinking. This happened in early 2021, when a wave of retail interest pushed more investors to stand for delivery instead of just closing their positions for cash. The exchange didn't default. Deliveries were met, but the friction showed up in the data. Part of why this matters more for silver than gold comes down to silver's split identity. Gold has been almost purely a monetary metal and store of value for thousands of years. Silver has always done double duty. It was literal money across ancient Rome, imperial China, colonial America. It's also an industrial metal now used in solar panels, electronics, EV components, and medical equipment. When investors buy it, they're often buying it for the same inflation, hedge reasons people buy gold. But industrial demand pulls on the same limited supply from the other direction, and unlike gold, a lot of that silver gets permanently consumed. Nearly all the gold ever mined still exists in some form. Silver doesn't work that way. Much of what goes into electronics and solar cells is used in quantities too small to make recycling worthwhile, so once it's gone in any practical sense. Above ground refined silver stockpiles have been shrinking for decades as industrial use has outpaced mining and recycling combined. The Silver Institute's own annual figures show global demand exceeding mine production in multiple recent years, a gap that has to be covered either by drawing down existing stockpiles or by mining companies ramping up output. None of this is new. Silver has a well-documented history of blowing up under stress. The most famous case is the Hunt brothers' 1979 to 1988. Nelson Bunker Hunt and William Herbert Hunt tried to corner the global silver market, and the price rocketed from around 6,000 ounce to nearly a $50 in a matter of months. Facing what it saw as a systemic threat, the exchange changed its own rules mid-crisis, jacked up margin requirements, and restricted trading to liquidation only. The price collapsed more than 50% in a single session, a day now known as Silver Thursday. The Hunts were wiped out. The real lesson from that episode isn't that silver can move violently. Everyone knows that part. It's that the exchange, the clearinghouse, and regulators have enormous power to change the rules mid-game when the system itself feels threatened. Keep that in mind anytime someone tells you with total confidence exactly how a future squeeze would play out. In 2011, a different kind of spike in this one driven by fear after the 2008 crisis and the Eurozone debt crisis rather than a deliberate corner. Silver ran from around 17 an ounce to almost in late 2049 by April 2011, largely on investors seeking protection from currency debasement. Then it fell hard again, losing more than a third of its value within days after the exchange raised margin requirements several times in quick succession. Both episodes share a pattern: emotionally driven rallies followed by sharp corrections, often set off by changes in leverage rules. That's not a reason to write silver off. It's a reason to treat it as an asset with a documented history of extreme volatility whenever speculation outruns the physical fundamentals. So what's actually different heading into the next delivery period? A few things, some confirmed, some still uncertain. The Fed has spent years navigating aggressive rate hikes to fight inflation, then recalibrating as the data shifted. Precious metals react to that because gold and silver pay no yield. High rates mean holding them carries an opportunity cost versus a savings account or bond. When rates fall or are expected to, that cost shrinks and metals tend to look more attractive. That's standard monetary theory, not speculation. Government debt is the second piece. U.S. federal debt as a share of GDP is projected by the CBO to keep rising under a range of policy assumptions. And the IMF and BS have both published research on how elevated sovereign debt across developed economies could affect currency stability. None of that predicts an imminent crisis, but it explains why a lot of investors, from retirees to large funds, hold some gold and silver as assets that exist outside the banking system. Third, central banks have been buying gold in record volumes per World Gold Council data, partly driven by the sanctions imposed on Russia's central bank reserves after 2022. When one government's reserves can be frozen by another, other central banks notice, and some have diversified into gold, which can't be frozen because it isn't a claim on anyone else's promise. Silver hasn't seen the same official buying since it isn't typically held as a reserve asset. But the same instinct, wanting to hold something that isn't someone else's liability, has spilled into broader metals demand. Here's how a delivery period actually works. Every futures contract expires, and as that date nears, holders decide whether to close their position for cash or stand for delivery and request the physical metal. Most large institutions close out. They were never trying to get silver bars. A growing minority, smaller investors, family offices, and industrial users who genuinely need the metal do stand for delivery. When that number rises relative to registered inventory, it creates real tension because the exchange has to source enough physical silver without disrupting the market. That's not automatically a crisis. Warehouses can shift silver from eligible to registered status, and bullion banks can pull metal from London's OTC market. But these things take time, and in a high demand period, the friction shows up, sometimes as unusual premiums on physical products relative to spot price, sometimes as delayed shipping from mints. During the 2020 pandemic, coin and bar premiums spiked even while the paper spot price stayed contained because supply chains slowed refining right as retail demand for physical metal surged. That premium gap between paper price and what you'd actually pay to hold silver in your hand is one of the clearest signals an ordinary investor can watch, and it just takes checking a dealer's price against spot. The mechanics only matter because of what they mean for actual people. A retiree who put 5 or 10% of her portfolio into physical silver years ago as inflation insurance isn't checking COMEX data daily. For her, this moment isn't about timing a trade. It's about whether the original reasoning still holds. A younger investor who got in more recently on promises of an imminent squeeze is watching the price minute by minute, feeling both fear and greed at once. Kahneman and Tversky's work on loss aversion showed decades ago that people feel losses roughly twice as intensely as equivalent gains, which is a big part of why speculative assets crash harder than they rally and why markets driven by short-term bets rather than patient allocation tend to produce the boom-bust cycles seen in 1980 and 2011. Recognizing that your own brain is wired to overreact is one of the more useful things you can know about yourself as an investor, regardless of what you hold. For a small manufacturer using silver in electronics or renewable equipment, a delivery squeeze isn't a trading opportunity at all, it's an operational risk. Higher premiums and slower delivery mean higher input costs and disrupted supply chains, no matter what the spot price says. And then there's the long-term investor that institutional research keeps showing tends to do better over decades, not through timing, but by sticking to a preset allocation instead of abandoning it every time volatility spikes. Financial advisors generally say the same thing about any asset class: position size matters more than timing. It's fair to be honest about the institutions on the other side of these trades too, since a lot of online commentary treats bullion banks as though they're deliberately suppressing prices. The regulatory history is more specific than that. JP Morgan agreed in 2020 to pay over $900 million to resolve CFTC, SEC, and DOJ investigations into spoofing, placing orders with no intent to execute them in order to move short-term prices. That's a confirmed legal outcome. What it shows is that precious metals markets, like most major financial markets, have had documented cases of manipulation by specific actors, and regulators have caught some of them. What it doesn't show is that every tight physical supply period is coordinated manipulation. Those are two different claims, and mixing them up doesn't help anyone understand the market better. Institutional investors tend to be considerably calmer about all this than retail commentary suggests. Large asset managers and central banks holding metals as part of diversified reserves think in decades, not delivery cycles. The World Gold Council and Silver Institute both published reports focused on multi-year supply and demand trends over short-term drama, and from that vantage point, 1/10th delivery month is a data point, not a defining event. That said, some analysts and regulators have genuinely questioned whether current exchange rules hold up under extreme scenarios, especially with industrial demand from renewables growing against already declining stockpiles. Those are legitimate, ongoing conversations, not fringe claims. It's possible for a market to have real structural tension worth watching without being on the verge of collapse, and resisting both the dismissive take and the sensational one is just the honest way to look at it. The psychological piece matters too. Fear and greed usually show up tangled together rather than as opposites. Someone might feel genuine concern about government debt grounded in real data, while also feeling the pull of missing out on a squeeze that online commentary insists is imminent. Being honest with yourself about which of those is actually driving a decision and having a plan for volatility set before it happens rather than during it matters more for silver than any prediction about where the price goes next. Here's what's actually known and what isn't. COMEX runs a paper market vastly larger than its deliverable inventory, and that's been disclosed for decades. Registered inventories have fluctuated before, including in 2021, without a systemic default, though with visible friction. Industrial silver demand, especially from solar, has grown and outpaced mine supply in multiple recent years per the Silver Institute. Fed policy affects the cost of holding non-yielding metals, and elevated government debt is a real ongoing subject for the IMF and BS. Specific instances of manipulation have occurred and been penalized, while broader claims of systemic suppression remain unproven. What nobody can honestly claim to know is how any particular delivery period unfolds, whether registered inventories tighten further, whether the exchange adjusts margin rules again, or which way price moves next. Anyone claiming certainty about the exact timing is guessing, and both 1980 and 2011 show that dramatic silver predictions have a long history of being wrong about timing even when the underlying concerns were reasonable. The silver market runs on two levels. One is fast leverage and driven by short-term speculation that has little to do with anyone's long-term financial security. The other is slow, finite mine supply, growing industrial consumption, a decades-long drawdown of above-ground stockpiles, and silver's long history as money outside the banking system. The squeeze headlines live almost entirely in the first world. Whether silver belongs in your own portfolio and how much is a decision that should be made with reference to the second one, based on your own goals and risk tolerance, rather than a single dramatic headline. Markets built on heavy leverage tend to hit moments of tension between paper promises and physical reality eventually, and silver's history bears that out. Industrial demand growth, central bank gold buying, high government debt, and shifting Fed policy have made the backdrop more complicated than it was a decade ago. Some economists think these pressures could eventually produce real physical tension in silver given its smaller market size relative to gold. Others point out the exchange has weathered comparable stress before, and that squeeze predictions have a long history of not showing up on the timeline their proponents expect. Nobody can predict markets with certainty, and anyone considering a position in silver or any asset should weigh their own goals and risk tolerance first. Next time a headline tells you to act before the next COMEX open, you'll know what actually matters. What's happening to registered inventories, what premiums look like relative to spot, what's driving industrial demand, what the Fed is signaling, and whether your own reasons for holding or not holding silver were built on understanding the system rather than on one urgent headline.